Okay, good afternoon, everybody. This is Andy Profit. This is the Income SIG based in Portland, Oregon at the AAI chapter here. We're a subgroup of the main chapter here at AAII. And I have a few warm-up slides here, and then I'll turn it over to Stephen, and he'll do his thing. And then we'll have Gilbert Ho later on talk about some economic indicators that I think are very interesting. So this is our usual disclaimer. You know, we are a bunch of folks that get together on a monthly basis and talk about income investing. And so everything that you see and hear here, you should take with a grain of salt and check with your investment professionals. By all means, we are here just to exchange ideas and share things and share ideas, and you should always do your own due diligence. I do this at every meeting. We're a bunch of self-directed investors learning from each other. We're looking for prudent, knowledgeable ideas. Since we're an income group, we're looking for a sustainable stream of income, and I'm sure Stephen will be addressing that when he talks. And growing that stream of income faster than the rate of inflation if we can. We're going to preserve capital, and of course, we're looking for long periods of holding periods, so to speak. This group is primarily aimed at people within the red circle, so to speak. These are people who, our demographic is basically people who are approaching retirement or are in retirement and want to hang on to their nest egg and see if they can maximize the income on it. So we're not necessarily here to maximize capital gains by any means. We're more oriented toward having a nice steady stream of income that grows on a regular basis. That's not to say that capital gains are not important to us. It's just of secondary importance, if you will, to the income stream. Just again, a reminder to everybody, we do have a Google group, and this group is, by the way, a private group, and you can post a message there anytime. So I know David and Tom and Sean and some of the other guys have been very active on that site. But I think that we've got some bashful people in our group that need to ask questions, make announcements, whatever website you find interesting. Of course, we would like it to be something that's income oriented, but we want you to post to that site and get some dialogue going, because we're all here to help each other. And so don't be afraid don't be bashful. Express yourself by all means. We love to have you guys use this site between our meetings. The other thing I wanted to mention, Todd, are you online by chance? Are you around?
Yes, I am, Andy. Thank you.
Do you want to say a few words, or?
Yes. First of all, I'd like to welcome everyone here that's here today as well. And Andy does a great job with this group. We are going to be having a general chapter meeting for AAII, and that's going to be, our next meeting is going to be on Saturday, the May 15th at 9 a.m. That's Pacific Coast time for those of you who are calling in from other time zones. And we're looking forward to this meeting. We've got a speaker, Ian Abbott, who recently retired as a principal of Abacus Financial Services. And Ian is one of his areas of expertise is risk management. And so he's going to be talking at our May 15th meeting on the subject of hedging hedging your investment portfolios, protecting from the potential principal loss. And he's going to focus on using inverse ETFs, exchange traded funds, as a tool to hedge investment portfolios. So they're a relatively new product that's been introduced during the last 5 years or so. But there's a lot to them, and Ian's going to be sharing his expertise because it is a handy way to employ a tool for risk management and limiting your downside risk, particularly in equity portfolios. So we'll look forward to that, and you're going to be getting, I think, an email on that, and to allow you to register for that meeting here and then during the next few days. But I wanted to make sure everyone had that meeting on your calendar. I think we mentioned before that that was a date, but we now have our confirmed speaker for that meeting, and we hope that you'll all be able to join us. That will be a webinar style meeting like this one. No in-person meetings yet, given the environment that we're in right now. So thanks, Andy.
Well, thanks, Todd. Todd is the president of the Portland chapter, and he does a superb job of lining up speakers and getting us all marching in the right direction, so to speak. The other thing I mentioned is that the link that's on the screen right now is the main chapter site, and you're welcome to click on that and sign up for the meetings. And then the green section down below is a list of past meetings that we've had at the AAI chapter, and of course the SIG members of the Income SIG. Those presentations are there as well. So both for the main chapter and for the Income SIG are all listed there. And when we finish recording this particular session, we'll post it there as well. So you can visit that site after the meeting and go over anything that any of our speakers have done. So just be aware of that going forward. Okay. Thanks, Todd.
Thank you.
All right, just a quick notice, make sure that you keep your mic turned off unless you're ready to ask a question. Steve is going to be our first speaker, and the way he's going to work, I think, is he's going to stop through his talk and ask for questions and so forth. So I'll leave that to him to do. And then at the end, if there are any questions in the chat box, Tom will read them off, or you can ask a question at that particular time. But keep your mic turned off while we're going through this, just so that we don't hear barking dogs and the wives yelling at spouses and so forth, Okay, so here's our agenda. Steve Shaw is going to be our speaker. He's been with Bond Savvy. He's founder of Bond Savvy. And actually he's spoken to our main chapter, I think once or twice in the past, if I remember right. And then Steve will be on for a while, and then for about an hour or so or whatever takes him. And then Gilbert Ho, who is from the Silicon Valley Computerized Investing chapter, has a set of economic indicators that I think we should all be following. And so I've asked Gilbert to walk through those indicators with us after Steve finishes his presentation. And then our May 2nd meeting will be at 1:30 on Zoom as usual. And we have Nicholas Ward from Intelligent Dividend Investor lined up to speak to us at that meeting. And then at the June meeting, we're going to ask Don and Peter from the Silicon Valley AAI Computerized Investing SIG to talk to us about some very interesting work that they're doing in portfolio allocations and how they go about it. I think it's very, very interesting and something that would benefit us here in the income group as well. So just kind of mark those on your calendar. Okay, so that's the end of my little spiel here. Steve, I'm going to let go of this and turn it over to you, and you can share your screen. So go ahead.
Okay. All right. Let me. Okay. Can you see my screen now, Andy?
I do. Yes. Yeah.
All right. Very good. Well, thank you so much for inviting me to speak. You're right. I did speak to the AAI Portland chapter. I believe it was January of 2019. So going on a couple of years ago, but glad to be here. So let's get going. So the title of the presentation is is how to profit from rising interest rates. And many people believe that rising interest rates are this horrible thing to deal with. But I'm going to show you how rising interest rates can actually be a good thing for bond investors. And on this first slide here, just to give you an idea. So first, it's important to look long-term because if we look just short-term, yes, there are going to be some bonds that are going to fall in price. But we look longer term, obviously interest rates increase, yields go up, and coupons could go up for newly issued bonds. And so as we look at investing in corporate bonds, and that's what we're going to be talking about today, individual corporate bonds, that's my focus. It's all in all a good thing. If you look at the year 2000, tons of companies issued debt. It was a record year because of all the bad things that happened in the early part of the year. You had so many companies going to the capital markets to issue new bonds. And those bonds, especially for good companies, were issued at very low coupons. But over time, if rates keep going up, then that's overall a good thing for bond investors. In addition, I'm going to show you how not all corporate bonds are sensitive to changes in treasury yields. When you look at high yield corporate bonds rated below BBB, those bonds are generally not sensitive to changes in interest rates. And because bond ratings can be very flawed, you can oftentimes find bonds that have low credit risk and have very little sensitivity to changes in interest rates. We're going to go through that as well. And the last piece is that if you go back 6 or 9 months, it was hard to find any bargains. And when we look for corporate bonds, we're looking to find bonds that not only pay compelling yields, but also have upside potential with prices that can go up. And there are lots of bonds from some of the best companies in the world. You've got bonds issued by Apple, bonds issued by Amazon, Eli Lilly, you name it, that have fallen 20%. And so it's been a blue light special on many of these bonds that represent buying opportunities that we haven't seen for a very long time. Now, when we talk about interest rates, it's important for folks to know that we're talking about, as it relates to corporate bonds, we're talking about treasury yields. And those treasury yields, I'm going to explain to you which ones we care most about. We're not talking about what the Fed does. We're obviously not talking about what the interest rate is on a mortgage or things like that, but we're talking about treasury yields, whether it be the 10-year treasury, the 30-year treasury. And we're going to show you how not all bonds are the same. Many people believe if you watch CNBC, they'll talk about, well, the bond market. And their view of the bond market is really maybe the 10-year treasury market. That's really the only bond market that they know. But I'm going to show you how within the corporate bond universe, there are many bonds that are not sensitive to treasury yields. Now, on this slide, what we're showing here is on the left-hand side, this is US Treasury yields. And you've got in the gray bar, that's the 30-year Treasury. In the orange is the 10-year Treasury, and in the blue is the 1-year Treasury. Now, these are all driven by the market. Okay, so obviously the Fed funds rate, that's driven by the Fed. Okay, and so now it's between 0% to 0.25%. That's driven by the Fed. That's a policy decision. But when you look at the 30-year Treasury and the 10-year Treasury, those are driven by what's going on in the market. So it's driven by things such as inflation expectations. It's driven by the historic level of Treasury issuance. But then on the other hand, it's also driven on the demand side in terms of, okay, well, what's going on with foreign buyers? When you compare U.S. Treasury yields to Treasury yields of other sovereign bonds, we're actually higher than what you would get if you bought a German government bond or a Japanese government bond. So you have some push and pull in terms of what's driving these different yields. But this is what we're concerned about. This is what we focus on, is what's going on with the longer dated treasury, so the 10-year treasury and the 30-year treasury. And I'll explain why that is in a moment. But the first thing I want to show you is as folks are aware, treasury yields have been ticking up. So I'm not telling anybody anything new there. They bottomed out in March of last year, and then they went up a little bit, they came down a little bit, but then there's been this steady rise, and it's kind of flattened out over the last call it couple weeks to where we are now. Now, you would think that, okay, treasury yields are going up, so every corporate bond price has got to be coming down. That's what investors have been hammered over the head with for years. But this bond over here, this is a bond issued by L Brands. So L Brands is the parent company of Victoria's Secret and Bath and Body Works. And that company has certainly had its struggles, but 2000 ended up being an extraordinary year for this company because Bath and Body Works had tons of, comparable sales for Bath and Body Works were a record because they sell the hand sanitizer, they sell things for the home, and so that was extraordinarily profitable. They reorganized the Victoria's Secret business. They're going to be separating these two businesses, and so L Brands had an extraordinary year from its perspective financially. And as a result of that, you'll see that, and this is the bond price. Okay, so this isn't the yield, this is the actual price of the bond. Bonds, you'll see on the right-hand side, if you're not familiar with how bonds are quoted as a percentage of their face value. So if you see a bond quoted at 80, that's 80% of its face value. The face value of a corporate bond is $1,000. So a bond quoted as 80 is worth 80% of $1,000 or $800. You'll see that this bond, it obviously, it tanked when in the midst of COVID-19, as stores were being shut down. But then as the company reported earnings and the earnings were strong, this bond continued to go up in price to where now it's about 120. Now, many people wouldn't believe that with a corporate bond, you'd have this much of an upside opportunity, but that's what happened. And the reason for that is that high yield corporate bonds, okay, so bonds rated below BBB, are not sensitive to changes in treasury yields. Okay, so you see this rise in treasury yields, but you had a rise in the price because the price of a high yield corporate bond is generally driven by two things. So first, it's driven by the financial performance of the company, and then also by fund flows and outflows, because the institutional market still in many ways can control the direction of the corporate bond market. So if there are lots of folks who are investing in bond funds, those bond funds are in turn buying more high yield bonds, and that can help propel the price of a bond such as L Brands. Now, this is different than an Apple bond. So Apple is one of the most highly rated bonds out there. So Apple is a AA plus rated bond. So obviously investment grade, and I'll explain the difference between investment grade and high yield a little bit later. But you'll see that as this bond, as treasury yields surged over the last several months, the Apple bond has fallen in price, as folks would typically expect. And the reason for that is that this Apple bond that's due in 2045 is an investment grade bond. When an investment grade bond is quoted on a Wall Street trading desk, it's quoted, I'm gonna hold off on that point for a moment. What I'll say now is that investment grade bonds are sensitive to changes in treasury yields. I'm gonna explain to you why that is in a moment. But just so you know, you've got different types of bonds. Not all of them behave the same way. In addition, since it's an investment grade bond, investment grade bonds typically have a much longer time to maturity. Those bonds are going to be more sensitive than high yield bonds, which typically have a shorter time to maturity. So it's something for investors to be aware of. When we then look at how bond funds have reacted to changes in treasury yields. Now, this on the right-hand side of this slide is VBTLX. That's Vanguard Total Bond Market Index Fund. that's the largest bond fund in the world, you'll see that it's not a very exciting fund, right? So this is the price. And so you'll see during COVID, it peaked at about 1150, and then it went down to like 1075, and then it just kind of hasn't really done anything. And the reason for that is that, yes, VBTLX does own a lot of bonds that are sensitive to changes in treasury yields. They own lots of treasuries. It owns lots of treasuries. But VBTLX owns 8,000 bonds. Some are short dated, some are long dated. There's some corporate bonds in there. Might even have some stocks in there. They've got basically everything. And as a result, when you have a fund that has 8,000 bonds, the returns are muted. And the upside and the downside is muted. And the challenge with this is, yes, if you're interested in making 2 to 3% with little upside or downside, then this could work well for you, okay? That being said, when you look at this Apple bond, so this is a bond that was trading about 125, and it's fallen close to par. Obviously, you've got a greater opportunity for now you've got a more compelling yield, but you've got a greater opportunity for upside and capital appreciation. So that's the, when you think about some of the key differences between investing in, say, a high quality corporate bond such as Apple. Yes, you're going to have greater pricing volatility. You can see how it went from 125, it was down to 90. So you are going to have that volatility. But if you can live with the volatility, you've got a greater opportunity for upside. Apple's not going bankrupt, so you don't have long-term risk of capital loss, and a higher coupon with a longer dated bond. When you look at ETFs, so this is the iShares LQD corporate bond ETF. So that's the investment grade corporate bond ETF. By iShares, this is the HYG ETF. You'll see that these ETFs, they did fall in price. The LQD fell from, call it 135 down to 105. So it's still, in the wake of COVID, these bond ETFs fell significantly. But since then, you haven't seen a huge amount of price change. But what is important is you'll see this is the investment grade corporate bond ETF, and you'll see that the price has fallen, as you would expect, because investment grade corporate bonds are sensitive to treasury yields. As treasury yields have spiked, this corporate bond ETF has fallen in price. High yield corporate bonds are not sensitive to treasury yields. And so even as treasury yields have spiked, you'll see that the corporate bond ETF has continued to do reasonably well in terms of its price. So when we look at a portfolio that we believe is well equipped for today, and today, and we don't, many people believe, well, interest rates have gone up, they're just going to go up, and there's no end in sight. And I understand that folks can believe that, but people have been saying that for the last 5 years, quite honestly. And yes, there's certainly, until we get through COVID and government spending mitigates somewhat, there's certainly a lot of factors that are buoying a potential rise in rates. But the same so-called experts were saying, well, there's no chance for rates to go lower when if we go back 3 or 4 years ago, and if you followed those folks, you would have never taken advantage of the treasury rally that happened. But when we look at a portfolio, and again, this is just speaking for this point in time right now, as we look at the bonds that we've recommended to our subscribers, right now we generally have about 3/4 of our recommended bonds are below investment grade, and then about 1/4 of bonds rated investment grade. Now, we don't just follow bond ratings, because I'll show you a little bit later, bond ratings are very flawed. They don't speak to the investability of the bond. They don't factor in the price and the yield and the maturity and all that kind of stuff. But generally speaking, we can find bonds now that are trading at a compelling value, that are trading at, say, in investment grade, that are trading at 83 cents on the dollar, 85 cents on the dollar, 90 cents on the dollar. And we always want to own some investment grade bonds, even though they are going to be more sensitive to changes in treasury yields. But then we also want to have bonds that aren't sensitive to treasuries and still have solid financials, but have higher yields than some of the investment grade bonds that are out there now. So generally speaking, and this is not, we don't say, okay, well, we're thinking 75%, and that determines specific bond selections. But I'm just speaking generally in terms of where we believe a portfolio can be well positioned now to take advantage of the environment that's currently upon us. This is how we're looking at it. When you think about, and I know this is an income group, as Andy was talking about, we do look at, in terms of how we approach bond investing, we do focus on total return. If you think about it, a dollar of capital appreciation is obviously if it's in a taxable account worth more than a dollar of interest income. And so our goal when we look at recommending individual corporate bonds is we're looking to find bonds that are trading at a compelling value. We typically hold bonds anywhere from, I'd say on the shorter end, 6 months, to the longer end, 3 to 4 years. What we're trying to do is we're looking to maximize the capital appreciation of every bond that we recommend. It's different when you own a bond versus when you own a stock, because when you own a stock, that stock can continue to go up forever, basically, without necessarily an upper limit. Bonds are a little bit different in that since you have a coupon and since you have a maturity date, there's effectively a ceiling on bond prices. So very rarely will you see a bond, bonds are priced as a percentage of their face value. And let's say if you buy a bond at par and that bond goes up to 130, there's not the greatest chance that bond's going to go up to 150 or 175. It can happen. It's generally only going to happen for longer dated bonds and bonds that are not subject to a call schedule. But it's important to be mindful of that, because I believe that as a result of that, it does not make sense to hold bonds to maturity. Because let's say you buy a bond at par and it goes up to 135, you want to make sure that you capture that 130, that 35 points of capital appreciation, because over time that bond is going to go back to par. And I'd rather have subscribers capture that 35 points and deploy that gain somewhere else where there's greater upside. That's basically what we do. And this is just 4 examples of bonds that we've recommended to subscribers. We show the price at which we recommended them. For instance, this Verizon 385 to 42 bonds. That's just a bond issued by Verizon, pays a 3.85% coupon, is due in 2042. We bought it at 89.72. And then as the bond increased, it was north of 15 points, we decided to sell it, achieve a 27% total return compared to the iShares LQD, which was 12.5%. And this can happen across a variety of holdings. Not to say that every bond you're going to make 25 or 26%. Sometimes you will get fortunate. For instance, we recommended this Tiffany bond at 103. Tiffany was then bought by LVMH. LVMH had a higher credit rating. And as a result, the Tiffany bond surged nearly 30 points. And we decided to sell that bond. We look for bonds that have good value. And so this Albertsons of 29 bond, we recommended it back in 2017. The bond had fallen in price because Amazon had announced that it was buying Whole Foods. People thought, okay, all the grocers are going to hell in a handbasket. We thought differently. And this is a bond that's increased about 40 points and achieved an 82% return. So to make a long story short, when we look to identify bonds, we're looking at bonds that not only offer compelling yields, because income is obviously extremely important, but that also have upside. And we'll show you how we identify these bonds a little bit later on in the presentation. So just a few points on the agenda for today. So first, we're going to compare individual corporate bonds to stocks, to munis, and to bond funds. Obviously, all those are income, can be income generating. We'll talk about how corporate bonds are not some monolithic asset class. We'll talk about why you should buy bonds online, how you can take advantage of corporate bond ratings, what we look to, things that we look for when we recommend bonds. And also, we talked a little bit before about why you should sell bonds prior to maturity. But I'm sure there are many of you who maybe have never invested in a corporate bond. So I just wanted to give maybe a quick, probably call it 3 or 4 minutes, a quick corporate bonds 101, and make sure that everyone leaving today knows how corporate bonds work, knows some of their advantages, and you can start to make investments should you choose. So this is a corporate bond. It's target 390s of November 15th of 2047. So this bond pays a coupon of 3.9%. The face value of the bond, $1,000 per bond, is due back November 15th of 2047. Since companies issue typically more than one bond, you can't just have a ticker symbol like a stock has. You need the CUSIP number, so it's a 9-digit CUSIP. Once you decide to buy a bond, you just enter that CUSIP into your online brokerage account, and the bond pops up. Since it pays 3.9% coupon, that's $39 per year. Interest is paid semi-annually, so it'll pay half of the interest payment on the month and date of the maturity date. So it'll pay half on November 15th, so $19.50, and then another $19.50 on May 15th. So if you own 10 bonds, you would get $390 in interest each year. Now, when you buy a bond, as I mentioned before, bonds are quoted different than stocks. You still have a bid and offer quote. So or bid ask quote. So you buy at the ask and you sell at the bid. You'll typically see, and when you see these numbers, 114, 115, that's what's called the price on a dollar price basis, okay? Compared to showing it on a yield basis. So this bond, you could have bought it at 115. Now, when you see that bond quoted, and we strongly recommend that folks buy bonds online because you have, as opposed to doing it through, say, a financial advisor who charges a markup, and let's say it's at a Merrill Lynch or a Morgan Stanley, and that financial advisor will only have access to his or her company's bond inventory, as opposed to when you use a Fidelity or an E-Trade or a Schwab or a Vanguard, you'll have access to what's called street inventory, which are all the bonds that are offered by all the dealers across Wall Street. So it's over 100 dealers. So this bond was quoted at 115. So that would be the price that you would see when you first looked for the bond. Now, let's say that you wanted to buy that bond. What happens is that the brokerage firm will charge you either a markup or a markdown, okay? So if you're buying the bond, they mark it up. So if you saw a quote at 115, the bond will be marked up by 0.1 points, or you buy it at 115.1. Similarly, if you were selling the bond, they would mark it down by 0.1 points. And so if you saw a bid quote at 114, the selling price would actually end up being 113.9. Now, back on the buy side, if I bought one bond, it would cost $1,151, because remember, $1,000 is the face value of the bond. 115.1% of that face value is $1,151. If I bought 10 bonds, that would cost me $11,510. You pay that plus any interest that's accrued from the last interest payment date through the date that the trade settles. So let's say that it was the same target bond. The bond last paid interest on November 15th. I have to make the existing investor whole with the interest that's accrued. So let's say if I went online and I bought the bond tomorrow, that's April 12th. The bond trade will settle in 2 days, so it'll settle on April 14th. So I'm going to need to pay accrued interest from November 15th, 2020 until April 14th of 2021. don't worry about that, because then when the bond pays its next interest payment on May 15th, you'll get the full coupon payment. Many investors get tricked up when we talk about yields. And again, my goal is to lay the foundation for everyone on this call who may not be familiar with this, so that you can understand how these instruments work. So again, same target bond. Now, regardless of the price at which you buy the bond, it's always going to pay you the same coupon. So I don't care if you buy the bond at 95, you buy it at 114, you buy it at par, you're always going to receive the same $39 per year in interest income. Now, where it gets a little bit interesting is how the price at which you buy the bond translates into the yield of the bond. So you've got the coupon. The coupon doesn't change, right? But the yield will change. And for yields, we're talking about two different types of yields. So first is what's called the current yield. That assumes that whatever you buy the price, or whatever price you buy the bond at, this current yield is your return on the bond, assuming no change, no future change in the price of the bond. So let's say if I bought the bond at par and then I sold it at par in 5 years, my annual rate of return on this bond is 3.9%. Now, if I bought the bond on sale and I paid $95 for it, remember, I'm still getting that same $39 in interest, but since I paid $9.50 for it, to calculate my current yield, I'm taking the $39 of coupon divided by what I paid for the bond, so $950, and that's my current yield of 4.11%. That's my annual rate of return, assuming that there's no change in the price of the bond from when I bought it. If I paid $114 for it, I'm still getting the same $39 a year in interest, but I paid a lot higher. So now my annual return is lower because I'm paid that much more for the same $39, and my current yield is 3.42%. And so when you hear people say that bond prices and yields move in inverse directions, that this is what they mean. It means that, okay, the price increased from par to 114 and my yield decreased. On the other hand, bond price decreased from par to 95, but the yield increased. Last piece is yield to maturity. So all yield to maturity factors in is that the fact that this bond, I'm due par. Okay, they're going to pay me, if I bought it for $950 a bond, they're going to pay me $1,000 a bond in 2047. And so this yield to maturity factors in that capital appreciation going from 95 to par between now and 2047. So it's obviously not a huge difference because that 5 points of capital appreciation is happening over 26 years. You'll see if you bought the bond at a premium that the yield to maturity is lower than the current yield because you're now losing 14 points of capital over 26 years. So my yield to maturity is now 3.11%. I'm going to pause now just because we've gone through a lot of stuff. We've gone through how bonds are quoted. We've talked about yields. We've talked about how bond prices move. I'm going to pause now just to see if folks have any questions so far. You can just enter those in the chat.
Don't forget, you can enter in the chat or you can turn on your mic and ask your question too, either way. Don't be bashful.
All right, we'll wait a few seconds, and if not, then we'll keep rolling. All right, don't see any questions, so we'll keep going. So let's talk about, we're here in an income investing group, so let's talk about some of the key investment considerations. And I'm sure, as you're looking at income, you're looking at individual corporate bonds is one option, municipal bonds, bond funds and ETFs, dividend stocks. And so first we're going to talk about individual corporate bonds versus bond funds. And the way that we look at it is that when we make any investment, I don't care what it is, whether it's a stock or a bond or a stamp collection. We need to understand how that investment is priced relative to others. And we need to know the ongoing costs of that investment, because that ongoing cost is obviously going to mitigate your income. And when you look at bond funds, you really don't have either of those, because you can't compare the relative value of a bond fund, because bond funds are priced off net asset value, and you can't take any sort of multiple. There's no real, you can't say, okay, well, there's no such thing as a price to earnings ratio for bond funds. You can't look at a leverage ratio. There's really no way to understand the relative value of a bond fund. They own thousands of bonds. It's impossible. You just can't do it. And in addition, bond funds are hurt by very large turnover because there's so much buying and selling. There's a huge amount of fees that are in there, transaction costs, which are not disclosed to the investor. And these fees are huge. You look at some of the largest bond funds in the world and you look at their turnover. PIMCO Total Return Fund, this is from a couple of years ago, but a turnover of 700% of the fund. It's a $65 billion fund. So think of how huge that is. So you've got $65 billion turning over 7 times. So they're selling $420 billion of bonds and they have to buy it back. And that's an extraordinarily expensive proposition. You see the prices of these bonds, of these bond funds, one price at 112, one's at 11. You can't understand the relative value of that compared to an individual bond immediately, because they're all priced off the par value scale. You know right away, okay, if this bond is priced at 80 or 85, you know that it's a potentially very compelling value compared to if it's priced at, say, 135. So it's a tool that you have that a bond fund investor doesn't have. And when you look at some of the other things, you can be selective. You can own a nice select portfolio of bonds, whether it be 10 bonds or 15 bonds that suit you. Whereas you can't really do that with a bond fund, because they're so big, and you can't apply a bond fund to your specific situation. They're much more transparent. If you own an individual bond, let's say you are a hold to maturity to investor, the only fee that you're going to incur on that is when you buy the bond. You're not going to incur any additional fees throughout the life of that bond until you decide to sell it. And you also have a better opportunity for higher after-tax returns, since capital appreciation is part of the game, and it's not really part of the game for a bond fund. You can have a little, but you can't have much. When we look at comparing individual corporate bonds to some other types of income investments, and let's just talk about these different criteria. So we got high potential returns, transparency, security of principal, security of income. So you're all income investors here, and let's just compare security of income, individual bonds versus stock. So let's just go back to 2020, and you had some of the bluest of the blue chip companies. You had Royal Dutch Shell, you had Disney, you had Boeing, you had AB InBev. Some of the best known companies in the world either suspend or slash their dividends. And so that doesn't happen in corporate bonds unless a company goes bankrupt, which is obviously a low likelihood, especially if you look at investment grade bonds, which typically have default rates of about 0.1%. So if you're focused on income security, that immediately gives individual corporate bonds a material advantage compared to dividend stocks. So to say that all dividend stocks, most dividend stocks kept paying their dividends, but it's important if you're an income investor to at least have some exposure for individual corporate bonds, because you've got stronger security of principal than compared to stocks, stronger security of income. You obviously don't have as high a potential capital appreciation opportunity as stocks. But when you then compare it to bond funds and muni bonds, you've got higher potential returns, and you have a higher level of transparency, because you have the same financial disclosures that a stock investor has. A muni bond investor is only seeing disclosures once every year, and those disclosures get out of date pretty quickly. It's hard to buy and sell muni bonds. And bond funds, the disclosures happen, I guess they happen a couple times a year, but the only disclosure that you're getting is kind of a listing of all the bonds that are there, which quite honestly doesn't do you a whole lot of good, because that bond fund is always turning over. So many of you might gravitate to bond funds because you believe, well, execution is so much better if I buy a bond fund because it's the big guys who really have an advantage. Well, folks, that's wrong. I spent about 5 years of my career working for companies. 2 of those were TradeWeb and the other was BondDesk. We built the technology for the largest retail brokerage firms to trade bonds for individual investors. We worked with the Schwabs and the Fidelities and the Wells Fargo advisors and all those folks of the world. And I can tell you firsthand how efficient that market's become. I obviously, anytime I make an investment, I do it online. And it's night and day compared to how it was, say, 25 years ago, where you call up this gentleman, he'd kind of tell you, all right, well, my brokerage firm has this bond at this price. Now it's entirely different. This is what's called the depth of book on slide 23. It shows quotes for an eBay bond, eBay 4s of 2042. These are all quotes. You've got the bid side on the left, you've got the offer side on the right. These are all quotes that are made by dealers. So you'll see that you've got 12 quotes on the bid side, 14 quotes on the offer side. You've got a narrow bid-ask spread, 99.97 on the bid side, par 0.094 on the offer side. You see the yield, 3.99 on the offer side, 4% on the bid side. So that's a 0.01% difference, also known as 1 basis point. That's right on top of where the institutional market trades. Sometimes it's an even narrower bid-ask spread than what you see the institutional market trade at. You don't have to buy in large quantities. You'll see the minimum quantity. So if I bought at least 2 bonds, I would get the best quote that was offered. You generally want to transact somewhere between 2 to 10 bonds. So your last name doesn't have to be, you don't have to be Phil Knight to go and buy corporate bonds. You don't have to be a billionaire to buy corporate bonds. You can be an investor of virtually any size and be traded fairly and have high quality execution in individual corporate bonds. And when you go and buy that bond, let's say 95 times out of 100, that trade will get filled within a second. Okay. We stopped for Q&A a little bit, so just keep moving through. So I want folks to understand what drives bond prices, because that'll help you understand how you can find opportunities, as well as why certain bonds behave differently than others. So this on slide 26 is the performance of that same Apple bond that we talked about before, the Apple bond that's due in 2045. These dots here are the price performance of that bond. Going back to the end of 2019. So you'll see the beginning of 2020, the bond was priced at 121.83. It was trending up. It peaked at close to 136 on March 9th. Then you had the onset of COVID. The bond fell 40 points, if you can believe an Apple bond could fall 40 points. But then as the Fed took action, the Fed significantly increased its balance sheet. The Fed cut Fed funds rate down to 0. It announced a corporate bond buying program. The market stabilized, and the Apple bond, boom, within a minute, was back up. At least, it took maybe about a few weeks to get back up to where it was trading. The moral of the story here is that as investors, we always want to have, I'd say, a handful of bonds in our back pocket. That would be from the Apples, the J&Js, the Targets of the world that are really strong companies, and that if there's something that goes really haywire in the market, you can go and buy those bonds at a significant discount. It's not going to happen often, but it did happen about a year ago, and so it's a recommendation that we have. Now, if we think about what caused that Apple bond to change in value. And here across the top, we have the price of that Apple bond. So it's the same price that we showed back here. So, and these are the dates. So you'll see January 2nd of 2020, the Apple bond was priced at 121.83. March 9th was priced at 135.9. And then you'll see how it was priced the rest of the year. But to really understand what caused this bond to move, you need to look at the yield to maturity of the Apple bond. And this yield to maturity, so when it was priced at 121.83, the yield to maturity was 3.12%. That yield to maturity has two components to it. It has what's called this blue bar. That's what's called the benchmark treasury yield to maturity. And it sounds like a fancy term, but all it means is that there's a treasury bond that's due right around when this Apple bond is due in 2045. And on this date, on January 2nd, that bond had a yield to maturity of 2.26%. But the Apple bond had a yield to maturity of 3.12%. The reason there's a difference is that the Apple bond is deemed to have a higher risk of default than the US government. I'd probably differ in opinion from that, just given Apple's got $250 billion of cash, highly profitable compared to the US government, which runs a deficit of about $3 trillion a year. That all being said, this is how the market works. And so the difference between the benchmark treasury yield to maturity and the yield to maturity of the Apple bond is what's called the credit spread. That credit spread on this date was, and that's what's shown in orange, is 0.86%, also called 86 basis points. 100 basis points is equal to 1 percentage point. And so that was the situation of that bond on January 2nd of 2020. Now, the price obviously changed from then. And so let's talk about what drove that price. So when an investment grade bond is quoted on a Wall Street trading desk, it's not quoted as these dollar prices. So it's not quoted as 121.8 or 135.9. That's the price you see in your brokerage. You'll always see the dollar price in your brokerage, but when a bond gets quoted on a Wall Street trading desk, when an investment grade bond gets quoted on a Wall Street trading desk, it gets quoted as the credit spread. So let's say the credit spread on this one was 86 basis points. And let's say, and this is on the offer side, if on the bid side, let's say it was 89 basis points. So the quote would be 89.86, which is the credit spread on the bid side and then on the offer side. So as the credit spread moves up or down, and as this yield to maturity moves up and down, that's going to impact the yield to maturity of the Apple bond, and then in turn is going to impact the price of the Apple bond. So you go from January 2nd to January of 2020 to March 9th. There was a flight to safety. Treasury yields went down significantly, but there was deemed to be more risk in the corporate bond market. So the credit spread increased. It effectively doubled for the Apple bond. But since the treasury, since the benchmark treasury fell so much, the yield to maturity of the Apple bond fell from 3.12% down to 2.45%, and the price of the Apple bond went up to 135.9. Then you go to the depth of COVID-19, even treasuries, because there was a lack of liquidity in the treasury market, treasury yields spiked, credit spread spiked, it doubled again. And as a result, the yield to maturity of this Apple bond was well all the way up to 4.6%. The bond price fell 40 points, which is crazy, down to 96.7. And then after the Fed took all of its action, there was a more normal circumstance. So you had treasury yields fell a little bit down to 1.41, and there was a significant shrinking of the credit spread. Those two factors combined caused the price to then go back up about 35 points. So when you think about investment grade corporate bonds, long dated investment grade corporate bonds, this is what causes them to move. So if there's a rally in treasuries, when I say a rally, that means the prices go up, yields go down. Assuming the credit spread doesn't change, that's going to cause, generally speaking, investment grade bonds to go up in value. Opposite is true on the other hand. If you'd like to learn more about credit spreads, go to the Bond Savvy website, click the Learn box, Corporate Bond FAQs. You'll see a blog post called What are Credit Spreads and How Do They Work? Why don't we stop briefly for any Q&A. Rather through the chat or shout it out. Okay, all right, let's keep on going. Okay, so everyone here is familiar with a bond rating. We all know, going back to the financial crisis, how bond ratings can often err. But they're still important. And the reason why they're important is that they impact how bonds trade, as well as how bonds are priced and how they react to changes in ratings. So this is the corporate bond rating scale. You've got investment grade, so anything above Baa3. So this, Moody's and S&P, those are the two main rating agencies. Anything Baa3 and BBB minus above, that is that's deemed what's called investment grade. Anything below that is below investment grade, also called high yield. Some people refer to them as junk bonds. I've never called a bond a junk bond because many companies, as I'll show you in a couple of slides, many companies that are rated single B or double B oftentimes have superior financials than those rated triple B. You just got to do the homework, which is obviously what we do. The reason why these ratings are important is because if a bond is initially rated investment grade, that bond is going to trade similarly to this Apple bond because of how it gets quoted on a Wall Street trading desk. Since it gets quoted as the credit spread relative to the benchmark treasury, as treasuries move up and down, that bond is going to be sensitive to those changes in treasuries. A bond that's rated double B or single B is not going to be sensitive to changes in treasuries. And so knowing what a bond is rated helps understand the level of interest rate risk of corporate bonds. In addition, since most bonds are owned institutionally, those institutional investors are often index funds. Those index funds have specific rules in terms of the bonds that they can own. Many of if you look at VBTLX, the Vanguard Total Bond Market Index Fund, it can only own investment grade rated bonds. So if a bond gets downgraded to below investment grade, bond funds such as that and scores of others have to sell that bond. And that's going to cause the bond price to fall, which can be a nice opportunity if you own individual bonds. Now, while you need to know the bond ratings, there are lots of shortcomings to bond ratings. The bond rating does not speak to the investability of the bond. It's not speaking to the value of the bond. It doesn't factor in the price or the yield, the maturity date, or the default risk of different bonds within similar. Let's say a company has 50 bonds. Generally speaking, unless if a bond is secured with different collateral, all the bonds are going to have the same rating. It doesn't matter when the bond is due. They all have the same rating. So they basically kind of throw a lot of bonds together. They can go years without changing. And so if you're looking for a signal from a bond rating as to, okay, you're going to wait for an upgrade or a downgrade as to when to buy or sell, you're going to be hearing crickets for a while. And as I'm going to show you in the next slide, they often focus on fuzzy math, on really things that aren't quantitative, as opposed to focusing on the core credit metrics when they determine ratings. Now, I saw a couple of questions come through in the chat. Okay. Okay. I'll focus. Let's go. When are you giving out your next set of bond suggestions? So that'll be. We just made a set of recommendations in March. We updated them March 25th. We'll make a new set in May. Next question. Okay. What do you anticipate for the U.S. Treasury market when the Federal Reserve ends its $120 billion bond buying program? Won't interest rates rise to attract investors? Okay, so the thing is that the Fed can't overpower the Treasury market. So the Fed has continued to buy treasuries, but we've seen that it can't overpower. If you think about it, the treasury market is 21 trillion in size. The Fed's balance sheet is 7 trillion in size. Now, the Fed's balance sheet is comprised of both treasuries and mortgages and lots of other stuff, but it's hard, the Fed will impact it, but it's really more of the overall market which drives it. And so you've got push and pull. So in terms of what can drive rates lower, you've got Fed buying bonds, you've got foreign investors buying bonds, because we're the best house on the block in terms of the highest yield compared to our risk. But then obviously you have inflation concerns, you've got significant government spending. We're not, we do not have a crystal ball on treasuries. The way that we look at treasuries is that when we look to buy investment grade corporate bonds and we're buying a bond at say 80 or 90 cents on the dollar, we don't know if that bond's going to go up in price in 3 to 6 months, but we have a pretty good feeling that in 2 to 3 years, that bond's going to be at par or higher. And that's a really good investment because let's say you bought the bond at 85 and it goes up to par in a few years. You've got 15 points of capital appreciation. You've got the yield. It can be a very compelling investment. So let's just look at on the next slide, on slide 32, how often bond ratings get things wrong. And so you'll hear a lot of the triple B market and how anything rated triple B is just a bad investment. But when you look at Kroger and AB InBev, so Anheuser-Busch InBev, these are bonds that have very similar ratings. They're both triple B rated. But when you look at the financials of the company, they couldn't be more different. So Kroger was buoyed by COVID-19. AB InBev was hurt because of so many closed restaurants and bars. AB InBev has significantly higher debt relative to its what's called its EBITDA, which I'll explain in a moment. EBITDA is just its cash flow. You'll see this metric, which is called the leverage ratio, which is total debt divided by EBITDA, much lower for Kroger, so about 2 times compared to AB InBev, which is 5 times. 5 times is really, a bond should be rated single B or maybe triple C if it is 5 times leverage, especially if its financials are worsening as AB InBev's was. So AB InBev has no business being a triple B company. Same thing I said when Kraft Heinz was rated triple B about 2.5 years ago. Luckily, it's gotten downgraded. But it just shows you that just because 2 bonds have the same rating, their financials can be vastly different. And the reason for that on slide 33 is that the way that bond rating agencies calculate their ratings is often misguided. What bond rating agencies do is they look at a bunch of factors across different industries. So Moody's looks at the retail industry and all the other industries. They look at alcoholic beverage industry. So that's, retail is Kroger, alcoholic beverage is AB InBev. And then they assign different weightings for different factors. So you'll see leverage and coverage. So leverage is that's debt to EBITDA. Coverage is the company's EBITDA compared to its interest expense. And so you'll see that for Kroger, within the retail industry, it's a pretty significant portion of its rating, 45%. It then weighs financial policy, 15%. Financial policy is just what does a company do with its profits? Is it putting it into capital expenditures or is it just buying back stock? And then it weighs some of these other factors: business profile, the size of the business, which is its revenue. But then you look at those the same factors for AB InBev, and it's skewed. So it only weighs leverage and coverage 30% of the overall weighting. Then it weighs scale, which is revenue, 15%. Then the largest factor is this business profile, which is or fuzzy things such as diversification, exposure to riskier markets, global industry position, and this one's a real doozy, innovation, brand strength. And so, I don't care how innovative a company is. if a company has 5 times leverage and significantly greater debt relative to its EBITDA than a company that has 2 times leverage, that's a higher credit risk. But because of all the fuzzy math that these bond rating agencies use, you'll have lots of companies that have bonds that are misrated. And if you invest in individual corporate bonds, you need to know this because you can't just blindly follow a bond rating. It helps folks find bonds that can be rated below investment grade, pay higher coupons, and have less interest rate risk than say an AB InBev. Okay, so how do we find bonds that can outperform the market? So we talked about some of the metrics that we look at. So we refer to EBITDA. So all EBITDA is earnings before interest, taxes, depreciation, and amortization. Everyone's familiar with net income. All we're doing there is we're adding back the non-cash items. So we're adding back depreciation and amortization. And then we want to know the cash that it has to pay its interest. So that's why we look at earnings before interest and before taxes. And so we look at interest coverage, which is just EBITDA divided by interest expense, leverage, which is debt divided by EBITDA. If you think of the scale of these metrics, anything generally 3 times and less is reasonable risk for a leverage ratio. We just start talking 5.5, 5, 6 times. That's when you start to get pretty nervous. If you think about it, it doesn't take much. As you start getting to 6 times, if that business has a hiccup, and that leverage goes up to 8 times and 9 times, it's really hard to recover from that. Interest coverage, generally anything more than 10 times is pretty safe. Alphabet, the parent company of Google, has interest coverage of 350 times. So, that's a pretty safe investment. And when we look to find value, we look to find bonds that are not only have compelling coupons, compelling yields, but also upside potential. We're looking at all these different factors. So these are the 4 bonds that I mentioned before: Verizon, Bed Bath, Tiffany, and Albertsons bonds. So when we're looking at those bonds, we look at the leverage ratios. We look at the growth of the company. We look at the upcoming bond maturities of the company. We want to understand, okay, what type of call schedule is there? Because let's say a bond is priced at 110 and it's callable at 105, and that obviously mitigates any upside that's available in that bond. And then we're comparing it to, on the left side, the credit spread and the yield and the price of the bond. And so when we looked at these bonds, so we recommended the Verizon bond and the Albertsons bond on exactly the same date. When we looked at this Verizon bond, it had 2.5 times leverage, but it had a credit spread of 1.82%. It had a yield of 4.55%, and it had a price up here on the upper left of 89.72. So we felt that compared to other bonds that were out there in the marketplace, we felt that the bond could go up in price, and we were also getting a compelling yield to maturity of 4.5%. When we looked at the Albertsons bond, we thought it was an even more compelling story because yes, the leverage was higher, but you were being compensated so much more for that bond. You're being compensated, your yield to maturity was 10.7%, you had a price of 78.5%. And you remember from the first slide that this bond, Albertsons bond, is now priced at 118. We sold this Verizon bond at 106. So we're trying to, we find these bonds that we obviously love a yield of 10%, but we like even more that capital appreciation of the 40 points that we're able to get. Obviously, you can't, capital appreciation is harder to come by this year. So the coupon and the yield is even more important than it was, say, in other times. And so things that we look at. So we talked about the overall outlook and what type of momentum the company has. There are these things called financial covenants, which limit the amount of indebtedness a company can have relative to its cash flow. What's it doing with its earnings? Where are we in the capital structure? Is there bank debt ahead of our bonds? And we also look to, we don't believe in over diversification. We believe that it's better to have a bond portfolio of, say, 10 to 20 bonds and a bond portfolio of 500 bonds. It's impossible to monitor a portfolio of 500 bonds. It's also impossible to really beat the market if you have that amount. But we do believe that within industries and within types of bonds. So we don't believe that you just want to own one type of bond. We believe you want to own some high yield bonds, some investment grade bonds, some bonds of shorter time to maturity, some of longer time to maturity, different industries. That's how we think about diversifying a bond portfolio. Now, just some final, quote unquote commandments, if you will. So I believe it's in investors' interest to own bonds direct. The more you have in between you and your investment, so if you own it through a bond fund, you think about that bond fund. Think about all the people who are there managing that bond fund, all the compliance people and the HR people, and then all those expensive fund managers and the buildings that they own and all that kind of stuff. That's a lot. And it's not Vanguard says that is a 0.05% expense ratio. That's nonsense because it doesn't include the transaction cost. So you want to own it direct. You want to own the bonds direct online. That's how you have the most transparency, the lowest fees, the highest opportunity for returns, and the best transparency. We talked about owning bonds that have strong relative value. We do not believe that bond ladders are a good idea because a bond ladder, the primary investment criteria is the maturity date. We want to look at the fundamentals and find bonds that have strong financials relative to their yields and relative to where they're priced. We protect every dollar of capital appreciation that we have. That's why we want to typically sell bonds prior to maturity. One of the things that's bad about building a bond ladder is you're effectively investing a large amount of capital at once. We don't believe in that. We make recommendations across through the course of the year when opportunities present themselves, and we believe that's the best way to do it. And lastly, just because a bond is rated high yield doesn't necessarily mean that it is lower risk than a bond that's rated BBB. First of all, you could have superior financials, and you're going to have, generally speaking, lower interest rate risk. So just to quickly on myself and Bond Savvy, I hope that as we've gone through this, you can understand the importance of owning corporate bonds. They have strong potential returns. They're safer than stocks. Your principal is safer than a stock. Your income is safer than a dividend stock. But very few people use them. And so my goal, the reason why I founded the company is because I wanted to change that. I wanted more people to be able to invest in individual corporate bonds. Last year, we made 62 buy-sell recommendations. We typically make between 20 to 25 new buy recommendations a year. And if you look at our performance through January 29th, we beat the benchmark corporate bond ETF 73% of the time. If you subscribe by Tuesday at 5 o'clock Pacific, you can save up to $75 on a subscription. I hope you'll consider that. I've seen some other questions come in. Why don't I get those? And I believe I have another minute, and then we go to the next speaker. Okay, next question. What is a typical holding time for bonds that you have recommended? Typically anywhere from 4 to 6 months on the short end to 3 to 4 years on the long end. There have been some cases where we've made a recommendation, like that Tiffany bond that I mentioned earlier, where the bond increased significantly in price, close to 30 points. We didn't see more upside in the bond, and we decided to sell it because we wanted to capture that. We wanted to secure that close to 30 points of capital appreciation. Let's see, what was our turnover last year? So we had 62 total recommendations. Of those, we had 22, and these are ballpark, 22 new buy recommendations. We had about 25 resume buying. So often, times we'll issue a hold, and then after things change, we'll have bond purchases resume. And we sold a little north of 20 bonds. So right now, if you look at our recommendations, we have about 20 bonds that are recommended as buys. And yes, does Bond Savvy publish our performance? If you go to the Bond Savvy website, click returns, and you'll see all the returns of all the bonds that we've previously recommended. Last question, and then I know we need to turn it over. You've recommended Fidelity for buying bonds. Is Vanguard also good? So I would put Fidelity as best in class. Vanguard's also good. One of the benefits of Fidelity is that you can enter limit orders. You can enter a limit order that is in between the bid and the ask quote. The fees are about the same. However, if you have less than $500,000 in Vanguard, the fee per bond, you'll pay $2 a bond as opposed to $1 a bond, which you pay on Fidelity. So Vanguard, I would say, is still good, not as good as Fidelity. I'd go Fidelity, E-Trade. Then I kind of put Schwab. I don't know Interactive Brokers as well. And then I kind of put, problem with Schwab is that you don't see the live bid side. I put TD Ameritrade at the bottom. And Vanguard, Vanguard's still a respectable platform. It does. I've executed trades there before, and it does a good job. Not as quite good as Fidelity, but still good. We are now at 2:45. So I think that's all the time that I have. So thank you so much. I really appreciate the opportunity to present to you. I hope you learned something. Of course, stay well. If you have any questions, send me an email, steve@bondsavvy.com, or give me a call, 201-748-9862. Thanks so much, everybody. Thanks,
Steve. Do we have any more questions? Tom, is there any more questions on the list there that we can offer for Steve here?
No, he was watching them and captured all the questions and responded to them.
Okay, fantastic. What is the cost of your service, Steve? I know that you're offering a discount, but I didn't.
Sure. So we charge $450 a year for 1 year, $750 for 2 years, and then the discount is $55 off the 1 year, so it would cost you $395 for 1 year, and then $75 off the 2 year.
That's a pretty good deal. Yeah, that's fantastic. Wow. Steve, why did you choose corporate bonds as opposed to some of these other vehicles like munis or some of the government bonds approach? What was the refresh my logic on that a little bit, would you?
Sure. So I spent my entire career in corporate finance. And so I started as an investment banking financial analyst back in the 90s. And so my job was to evaluate the financials of companies in the context of either a merger and acquisition, capital raising. And so I know how to analyze companies. And I know that, and what I'm able to do is to put that knowledge together with the knowledge I have of corporate bond trading platforms like Fidelity and E-Trade, and be able to put that together. And then many years ago, I started investing in corporate bonds on my own. And I saw the types of returns that one can generate with lower risk than stocks. I used to have almost all of my portfolio in stocks. Now I have all my portfolio in individual corporate bonds. And so I saw the strong returns. And if you compare it to, say, treasuries or munis, it's really hard to, in treasuries, you're just making a call on interest rates. And I'm no better a judge at what's going to happen to interest rates than other folks. With munis, again, since there's such a limited amount of financial disclosure with munis, it's hard to make a call in terms of the evolving creditworthiness of a company, of a municipality compared to a company. Because when you look at a company, that company is reporting earnings every quarter, and you have a really good idea in terms of how the company is doing. You can take that and then compare it to, okay, well, how are the bonds trading? What are they yielding? How does it look compared to other bonds, where it's much harder to do it with munis? And so that's how ultimately I decided to focus on corporates.
Any more questions for Steve? I see 10 people listed in the chat there. Don't be bashful, as they say. Steve, I saw that I visited your website a little earlier, and you had a YouTube channel there that where you did some testimony in front of the SEC, I guess,
Yeah.
regarding the spreads, I guess, or something like that. Was it the spreads?
Yeah, it was comparing. So it was giving the SEC an idea in terms of the state of the corporate bond market from a retail investor standpoint.
What was the outcome of that? I mean, that was a while back, wasn't it? I mean,
yeah, that was going back probably 2.5 years ago. That presentation was in front of a committee called the Fixed Income Market Structure Advisory Committee. And so it's primarily geared toward institutional investors. They're trying to figure out ways that bond trading can, if you think about an institutional investor's problem, they're trying to figure out ways that if they do a $25 million trade or a $50 million trade, they want to limit the market impact of that. And that's what this whole thing was about. But they asked someone from the retail side to go and present where the retail market is. And I gave some suggestions. That specific committee doesn't necessarily focus a lot on retail. I believe that there are some firms that are part of that took some of my suggestions and applied those to what they do. But that was the context of that. And so I wrote a paper that the purpose of it was to show that the conventional wisdom is that the individual investor gets screwed when he or she invests in bonds, but that's not true. And I showed how, okay, when you go and if you invest online, you have lots of benefits. You have lots of advantages because you've got 100 dealers who are competing for your order. You've got reasonably narrow bid-ask spreads. You've got small quantities in which you can transact. And so you don't need to have a $10 million portfolio, $1 million portfolio, or even a $500,000 portfolio. I made my first bond investment buying a quantity of 5 bonds. And that kind of started my interest in bond investing. And so that was the goal of it, to show investors that the individual corporate bond market is fair, but more people need to use it. That was the overall focus of it.
well, thank you. That was very good. Any more questions for Steve, please? Don't be bashful. Leslie, were you going to ask a question or something, or? Oh,
Steve, I asked one dumb question here. I have a bond fund TLT, which I think is based on the 20-year treasuries.
Yeah.
It fluctuates quite a bit, but in opposite directions to the stocks. And your corporate bonds on the graphs you showed, I think they pretty much followed the same trend as stocks. When you had that big dip in March of 20, the bonds went down also. But my question really is, go ahead.
Oh, no, so here's what happened, John. So I'm back on slide 6. So you'll see VBTLX is kind of the same thing as TLT. It's all, it's treasuries. And so you'll see that the price of this fell. So treasuries fell. But then treasuries came back. When you think about in terms of bonds moving in the same direction as the stock market, you look at this Apple bond, and so you'll see that the Apple bond, and we don't have the stock market over this, but generally, obviously, stocks have performed extraordinarily well over the last 6 months, and you'll see this Apple bond as a result of it being sensitive to changes in treasuries, it's fallen in price. And so here's the key question for investors. Let's say you like Apple, or let's say you like Amazon. Those bonds have now fallen to discounts of 20% from where they were. And who's to know what's going to happen with the stocks of those companies? But I would argue that if you can buy bonds of those companies that have fallen materially in value, those are generally good investments. But you're right in that when you look at a bond such as L Brands bond, yes, it's, this L Brands bond is driven more based on the financial performance of the company. I wouldn't say it necessarily trades in tandem with the stock market, but you've got the case where when it falls, everything got crushed last March. But generally, when corporate bonds fall, other than COVID-19, the falls aren't going to be as drastic. The upside isn't going to be as much, but you can still have strong returns, but with less downside than stocks. But again, it's not to say that the one's better than the other. I believe that it's helpful to own a variety, and I believe that individual corporate bonds can fit a nice piece in an investor portfolio.
But something like my TLC bonds, which aren't corporate, moves, well, the price fluctuates, so it went up considerably during the downturn. And I got into it initially because an advisor told me it would be a cushion against the downturn in the market. If the market goes to hell, the bonds are gone. This particular fund will maintain its value. But it's occurred to me in retrospect that I should have been trading it, just like you're saying, because it went way up and now it's lost significant face value as the market has recovered.
Yeah, certainly. I mean, it's if you look at what's happened to the yields, and that's where it gets tricky. And the reason why I like corporate bonds compared to, say, treasuries is that corporate bonds, you have, even with investment grade corporate bonds, you still have a credit component to it, in that you're looking at the credit worthiness of the company. Whereas if you're just in treasuries, then you're glued into, okay, well, what's happening with treasury yields, and those are really hard to predict. Those can be really hard to predict, and that's why when we look at investment grade corporate bonds, we don't look at it in terms of, okay, well, in the next 6 months, this thing is going to be a winner, but we do feel that, it's a very volatile world. There will be a treasury rally at some point. Who knows exactly when that'll be? But you need to obviously have a little bit of a longer term time horizon when you're in the treasury market, given how volatile it can be.
Thank you. Very helpful.
More questions?
Yeah, there are a few. So there's one, did you mention interactive brokers? So I've never used interactive brokers. I would say that interactive brokers has the same philosophy as the Fidelities, E-Trades, and Schwabs of the world, and that they're what I would refer to as open architecture, so that you get all of the quotes that are available in the marketplace. You get to see those quotes. I can't tell you, since I've never used it, I can't tell you how the overall execution quality is. Interactive Brokers is a really good company, so but it is the same philosophy compared to, say, a Merrill Edge or a traditional Merrill Lynch brokerage account, where Merrill Edge is only showing the bond inventory that's held, that's at the Merrill Lynch trading desk. And so as a result, you're not benefiting from the competition that's available from when you're on a Fidelity or you're on an E-Trade. So Interactive Brokers is the same philosophy as these other online platforms. I've never used it. Sometime over the next 6 months, I hope to do that. So convertibles, we don't. That's not part of our bailiwick. We just look at individual corporate bonds. It's where our expertise is. There's generally a greater level of liquidity. And first of all, you've got, on any given day, 9,000 individual corporate bonds are available to be traded across many different industries. You obviously don't have that depth with convertibles. Convertibles can be a good investment, but again, that's not our focus. Last question I see: what about an actively managed closed-end high-yield bond fund? So, the challenge with any bond fund, and if you compare it to, say, let's say you're an individual investor, and let's just say that you've got a $250,000 or $100,000 or whatever your portfolio size is, you can be highly selective. You can be highly selective. You can find bonds that are priced at compelling values, that have good yields. Now, let's say it is a closed-end high-yield fund. Now, I'm sure there are excellent high-yield managers. They've done very well, and so it's not to indict that whole industry. But let's say it's a $5 billion fund. You still have to find bonds that are, you still have to fulfill that size, and that's not easy. But, you know, again, what we do is we compare our performance to the performance of the iShares LQD corporate bond ETF and the iShares HYG ETF. And we've outperformed 73% of our picks. Those where we haven't outperformed, yes, we've had some duds, but sometimes when we haven't outperformed, it's because we've had a shorter dated investment grade bond that hasn't benefited from, say, the rally for longer dated investment grade bonds. That's what we compare our performance against. But again, you know, it's not to say that one is, you know, I compared bond funds to individual bonds a little bit earlier. But, you know, and I don't know the high yield closed-end fund space all that well, but, you know, those just be some of the considerations.
Any more questions for Steve? Steve, if you were to build a portfolio and keep it fairly diversified, how many bonds would you recommend your typically?
Yeah, I'd say, well, here's the first caveat that I would say is if you're new to corporate bond investing.
Let's assume I'm a new, yeah, okay.
Okay, so if you're new, I would suggest to build your portfolio over time. I suggest to go and make maybe 2 or 3 purchases. And let's say that your ultimate goal was to have $100,000 invested in corporate bonds. I would go and maybe make an investment of, say, of 3 bonds of 5, the quantity of 5 bonds each. So 3 CUSIPs, 5 bonds each. So that'd be about $15,000. And then as you get your feet wet, add to that. I believe a good bond portfolio is somewhere between 10 to 20 bonds. Because you want to have knowledge of those bonds. We do the monitoring of them if you use our service, but if you don't use our service, I think it's extraordinarily difficult to monitor a portfolio of anything that has more than 15, 20 bonds, because you just can't. I mean, you know, it's really hard unless
that's absolutely, yeah, you'd have to, yeah, you'd have to have
but I do believe it's important if you're new to build it over time.
Okay. Any more questions for Steve before we let him go? Okay, well, I guess, yeah, Tom had to drop off because he's got some other things going. Are there any other questions in the chat list that we need to address?
I don't think so.
You covered the convertibles, right?
Yeah.
Okay, yeah.
Yeah,
All right.
Got to all the questions. So I'm gonna stop share.
Okay. All right. Please do that. And then what I will do is say thank you very, very much, Steve. I really appreciate you taking the time out. I know we've taken you away from your family a little bit, but I'm sure that that there's been a lot of opportunities here for you, hopefully. So I will turn this over to Gilbert. Gilbert, are you around? Turn on your mic.
Yes, I am.
Okay.
I'll go ahead and share my screen.
All right, please do. And then tell us a little bit about your background and just to give a little more background on Gilbert. Gilbert is with the AAI Silicon Valley Computerized Investing Group, and he does an excellent presentation on the economy. And so I was so impressed with it when I visited their group. By the way, I'll put in a plug for them too. They are an excellent group, and you really want to give it some serious consideration if you have the time to listen in on their presentations. They're a very, very good group of guys. And hopefully we'll have more to say about that in the June meeting. But Gilbert does a little presentation. I guess you do it at every meeting, don't you? I think.
Yeah, I think well, the little history there is Al Zimmerman has been running the show for a long time, and unfortunately he passed away in early 2019, and so Don and Peter and a bunch of other guys continued the tradition, and I joined the group 2017. So I volunteered to do a few slides when we have a slack of good speakers. So I'm the filler.
It's more than I tell you, it's more than slack to me. I don't know. Okay, go ahead, go ahead and get started, and then we can look for questions afterwards.
Sure,
you're on.
Okay, so you guys can see the screen, right? The share.
Yes, I can. Yeah.
Okay, so there's my email address if there's any questions afterwards. So let me go on, and this is the disclaimer, and I did change the appropriate name to Portland, and basically none of us are responsible for the contents. All right, so this is really fundamental, or how do I say basic, compared to Steve's bond talk. It's really sophisticated. But basically, I'm just saying that as investors, we have to know the big business picture, business cycles, and most important, monetary policy that's it's happening right now or before. So I quoted here to say Federal Reserve implement the monetary policy to balance employment and inflation. And they use federal fund rates to control that. And the Committee of Federal Reserve on Monetary Policy meets 8 times a year, and they set the target of federal fund rates. And so if you go to the Fed, which I provided the URLs on top, right below the title, where these data come from, and this should be going over for each slide, and there should be relevant links provided. Basically, you can go there and you can look the federal fund rate, and the shaded area are what deemed to be the recessions. So as investors, we try to avoid recession. You try to get out of get enough powder dry before the recession, so you can buy more during the recession and rip the benefit after the recession. And if you look at the recession and the federal fund rate, you see that every single one of the recession is preceded by the going up of the. So let me try this fancy tool here. So you see that it's going up. It's going up. And even the latest ones is going up. So even if we don't have a pandemic, we're going to have a recession. And so what I'm trying to say is when I look at this and I go back far enough to look at these, 50 years ago, even in 74, where everybody think it's crude oil that's caused it, you can see the rate is going up. And in the 90s, it's the Gulf War, but it's also rate is going up. So that's just very important to know what the Fed is doing with the monetary policy. So yield curves, everybody knows that, and there are several ways of looking at this. Either you take the 10-year Treasury minus the 2-year, or you take the 10 years minus the 3 months. And usually people use the 10-year over 3 months because the previous slide showed that 3 months Treasury really kiss the federal fund rates closely. So that seems to be a good way to look at it. And whenever we have these negative yield curve, we pretty sure have a recession follows. So that's what we're saying here, negative yield curve raise the probability. And after the recession, the yield curve returns to the high. And So our current pattern is we're going this way, which is typical of an early stage of the economy recovery. So New York Fed, actually, they had a bunch of economic experts working on these, and they published papers, and they're saying, okay, we're going to take the yield curve 10-year minus 3 months, and we're going to push that 12 months ahead, and that would tell you the probability of a recession. So if if I just simply take the 25 as a line, so anytime we approach that, there is likelihood of a recession. So again, like 2020, you can see that it's coming. What this thing gives you is interesting is if you go to this page, which is provided here, and you put your mouse over the curve, you'll see the dates, and you'll see that they predict all the way, because they're 1 year ahead, so they're going all the way to next year, which is kind of interesting. This is another way of looking at the recession probability from a different angle. This is Philadelphia Fed does a survey every quarter called Survey of Professional Forecasters, and they're basically asking the experts, and based on the survey result, they actually calculated this thing called anxious index, which sort of predict or coincide with the recession. So it may not predict recession every time, but if it's really high, you're in one. That's another way to look at it. This was very commonly used by people. It's provided by the conference board, and it's called Leading Economic Indicators. And on this website, they provide every month after the release of the data, they update the chart, which is 6 months moving average on the 6 months rate of change. And you can see that anytime it's red, which is below 0%, we're either ahead or in a recession. And if you look at this current one from March, we are matching the recovery pattern. And finally, the Fed has 3 indicators on the stress on financial systems, and they are from different branches of the bank, and they gave an indication of the degree of shock we're experiencing there. I don't think they're predictive.
Gilbert, quickly,
yeah.
Can you enlarge the just to show one slide instead of the next slide? Can you do that, or is that possible? Because it's hard to read some of these URLs. Is that possible, or is it? If it's not, that's okay. Just, but I was just saying, if you could just show one slide at a time, as opposed to the next slide, it might help us.
Wait. So I just want to make sure you guys are seeing the full screen. You seeing 2 slides?
Yeah, I see. We see the main slide.
Okay. Let me change this. So give me 1 second.
Sure. Yeah.
Let me pause sharing, and let me get back to. Okay. Let me do this. I think now you're seeing the PowerPoint thingy, right?
Yes, I am. Yeah. Mm-hmm.
Okay. So actually, I'm doing a slideshow, but I didn't pick up the full screen. So let me try to get out of this and do this again.
It might be a little easier to read the slides that way.
Oh yeah, sorry, I didn't realize that was what happened, and I forgot. I must have given the wrong. I'm sharing.
That's fine.
I'm looking for this. This is sharing by application, and
the upper left is your slideshow. See that little icon with the upper left corner of your PowerPoint?
Okay, let me do this. Let me start sharing, and then I will say, because usually they give me the screen to pick, but I apparently picked the application. So let me try not to be fancy. Let me just move this thing and do the share, and I'm just gonna try to see if this would be better. Now you see the the PowerPoint, right?
Right. And I'm saying if you go to the upper corner of your PowerPoint, to the upper left-hand corner, and you go to the right, just a little bit there, click that. There you go.
Now you see one screen.
One screen. Perfect in
Okay,
every way.
this is what I thought you guys were seeing. I apologize.
Yeah, it's okay.
Okay, so I'm scrolling. And so this is the financial system stress indicators we were talking about. As you can see, we're on the right-hand side. Let me try that thing again, get my marker back. And we're here, and we're hunky-dory, we're in good shape. Okay, now we talked about Federal Reserve is on employment and inflation. So employment is front and center right now. And as of last August, I think everybody probably heard on the news that FOMC issued a statement that basically they're saying they're going to tolerate inflation more. And this is my interpretation. I just think it's a regime change. And basically they are saying we're gonna pay more attention to employment, so there'll be less suffering than worry about inflation. Because in the past, low employment generally, coincide with a higher rate. Basically, they are anticipating inflation. They're raising the rate, and so you can see that this is 3 months. This is the employment, and they are cross right before the recession. And since a lot of us are paid a lot into Social Security, we always worry about its health condition. And this is just a chart to show that we had a lot of people participating, and we're on a downtrend. And more importantly, this pandemic really created a shock. So, they have to put in more money later for us. Initial employment claims is very interesting. It's very important. It's a weekly number. And now if you believe that employment is now more important than inflation, then this is the worst to watch. And unfortunately, bad news is good news. So, usually on the early stage of recovery, all the bad news on the employment side keeps the Fed accommodating. So, stock goes up. And there is this, I think in the notes section of the, actually, I think I provided the link here. Basically, whenever you have higher employment, you actually have better stock returns. It's a cruel fact. So this is about employment, and then inflation. As this now everybody's worried about it. We're printing so much money that we must have a lot of inflation later. I just hope things will be so easy to predict. But basically, this is a long history of the inflation, and there is this University of Michigan Inflation Expectation Survey that is the green line that seems to track well with the inflation. And then with the TIPS, the Treasury Inflation Indexed Security, now we have something called break-even interest rate, which is the red, which is basically taking the 10-year Treasury minus the 10-year TIP, and that's the difference. And so this is a big picture. I try to zoom in for the last 20 years. So what happened is what I think encouraged Fed to say we will tolerate inflation is because after the great financial crisis of 2008, and we have 3 quantitative easing, you don't see inflation at all. And this is the data everybody said Fed used to measure inflation, and you can see that QE or no QE, the inflation is pretty flat now. So that's the belief now that the big picture or the big trends that the inflation is controlled. 40 years after 1980, Paul Volcker raised the rate to sky high, and we are going to tolerate inflation a little bit more and make sure people are getting employed. here is again Philadelphia Fed's a sort of a term structure. So they take different Treasury futures and the x-axis is how many months ahead. So this is like a 10-year curve, right? And you can see that as recovery goes, the expectation of inflation goes up. You know, from 2% to now 2.12%. This is my soapbox. Basically, I'm saying I think the big picture, the reason inflation was down is because globalization and technology. And globalization provided a lot of cheap labors, and technology reduced a lot of demand of labors. So these are big headwinds for inflation. Now people saying like we're printing a lot of money, but then again, all of us knows that the wealth is really concentrated, and there's a huge gap, and we have and all this money we printed end up inflating financial assets. So I think the question still to be answered is, are we really going to see significant inflation going forward? So again, Fed is the I call it the hands that feed the market, and they meet 8 times a day. 8 times a year, and there was one in March. So basically, they said, the Fed fund rate is 0 to 0.25%, as Steve mentioned before too, and they are spending $120 billion a month to buy the treasuries and mortgage-backed securities, and they raised the expectation of the GDP, and they lowered expectation of the employment, and they expected the inflation to be this. So this is more important, because if the inflation actually goes out of this range for a longer period of time, we might see them acting sooner of raising the rate. But this is why I say that they may be focused on getting employment fixed before they worry about inflation. Finally, this is just a sheet showing the central bank balance sheet. As you can see that, QE brought it up here. I didn't show what's before, but it's way down here before, and in 2008, and now we have another jump up. And here is the distribution of the maturity, so of what the central bank holds. Again, they are holding most of them in the 1 to 5 year mid-range, and they are about a lot of them over 10 years as well. Well, this is like saying, okay, so if you say where's the market, on the left I list a bunch of bullish factors, and on the right I try to list a bunch of negative, but in the short term it seems bull is winning the bear. So that's all I have. Back to you.
Well, thank you. Anybody have any questions for Gilbert before we wrap up here? I just wanted to, the reason why I like Gilbert's presentation is he lists all the references, and so you don't have to wait for Gilbert's presentation. You can you can go to these sites yourself and take a look at these things, and they're free. They're there for you to look at any given time, and I find them very interesting and very informative. And who knows, you could become an expert in this. Anybody got any more questions for Gilbert or commentary? Well, let's see. I see. Okay, so Gilbert, why don't you go ahead and release the slide sharing, and then I'll take it over from there.
Okay, And okay, I just start sharing. Thanks.
Okay. All right, thank you. And let me go back to here. And okay, so looks like thank you, Gilbert. That was outstanding. I want to put in a plug for your group, the Silicon Valley. By the way, the Silicon Valley AAI is an excellent site in general, and the Computerized Investing Group is, I think, one of the best around. Yeah, and you guys meet on, was it Thursday evenings? I guess the first of the month, is it?
Actually, I believe yes, the first Thursday. So the last one was April 1st, and the next one I believe is
May the 6th, right?
Yeah, right.
Okay.
Exactly. Yeah.
Okay, so yeah, you may want to visit their site, and if you just go to the Silicon Valley site, I'm sure it'll link over to it as well, and I'll put a link into our Google groups too for you guys as well.
Yes, Andy, I was just going to say the Zoom link is constant, so you can actually just put the Zoom link on the in your channel and in your group, and then people can just show up. It starts 6:30, first Thursday of every month.
Excellent, excellent. Okay, very good. Okay, just to wrap up here, is that our next meeting will be May the 2nd, and that'll be at 1:30, and we'll be on Zoom again. And Nicholas Ward from Intelligent Dividend Investor will be here to talk about how he goes about looking at dividend paying stocks. So that should be our next event. And then the June meeting, which I mentioned earlier, is we're going to have Don Maurer and Peter Liang from the Silicon Valley chapter talk a little bit about how they do portfolio allocations. And I think it's a very interesting approach. It's something that maybe we should be thinking about here from an income investor point of view too. And I think they're going to probably give us some very strong ideas on how we can do that. That's all I have for today. So I will stop sharing this, and I will say, do we have any other commentary before I wrap things up here? Well, let me look at the chat and see here. Looks like, yeah, this is all being recorded, so it'll be available on the AAI website within a couple of days. I usually try to get it over to John Wong within a day or so, and then, you know, when he has time, he'll put it up on the site, and so it'll be available there as well. So thank you very much for everybody, and we'll see you on May the 2nd. Don't forget, we have an AAI Portland meeting coming up on May the 15th. Don't miss that. That should be a very good one. So we'll see you guys in May, as they say. Bye-bye.